right, now let's get started on a required lump sum payment. And remember, these are from Time Value of Money from Brigham and Houston's Fundamentals of Financial Management. In this question, we will say that starting next year, you will need $10,000 annually for 4 years to complete your education. 1 year from today, you will withdraw the first $10,000. Your uncle deposits an amount today in a bank paying 5% annual interest, which will provide the needed $10,000 payments. How large must the deposits be? Now, if we were to lay out the situation on a timeline, this basically means that today we are going to make some amount of deposit. And for the next 4 years, we're going to withdraw $10,000 each year. So that means the amount of money that we invest today has to be enough for those withdrawals, while we earn 5% interest annually. Now, according to this situation, we're going to use the present value of an ordinary annuity formula, which in this case is PMT times 1 minus 1 plus I to the power of negative n, because we're discounting, divided by I, and that's that. Now, based on our inputs, we know that our PMT is going to be $10,000 because that's the amount for our payments. That's 10,000. 1 minus 1 plus I, and the 1 plus I takes the 5% annual interest. That's 1.05. And it's to the power of n because we need 4 years. So negative 4 and divide by I, 0.05. Once we plug all of that into a calculator, we'll get 35,459.51. So it basically means that that's the size of your deposit today in order to ensure that you have enough funds for your next 4 years worth of withdrawals. In part B, it says how much will be in the account immediately after you make the first withdrawals. That's basically like saying that how much interest will have built on this in the first year, and then when you withdraw that $10,000, what will be left in the account? So it's basically taking the future value and deducting 10,000 from it. And so to calculate the future value of our initial investment, we'll say it's present value times 1 plus I to the power of n. And the present value in this particular case is going to be 35,459.59. 1 plus I is 1.05, and the power of n means 1 because you've only allowed it to build interest for 1 year. Once we get an answer for that, we're going to deduct 10,000 from it. And so when you plug this into the calculator, you'll essentially get 37,232.49. We're going to take away $10,000 from this. That means that after our first withdrawal, we'll be left with $27,232.49 in our account. All right, don't forget to like and subscribe. Drop a comment below if you have any further questions.